Now, there's obviously a huge literature out there looking at how institutional investors influence firm-level governance. A big chunk of this literature focuses on activists who specifically buy shares with the intention of influencing management. Now, other papers, including a recent paper I have with Todd and Don, look at the role of passive investors. Now, this paper is different in that we specifically want to consider the interaction between these two different types of institutional investors. Now, to see why we're interested in looking at this, I'll start out by pointing out that we are in many respects in the midst of two major changes to the nature of institutional ownership in the US. So first off, activism has gone mainstream. There's hundreds of activist campaigns every year, and The Economist refers to their current scale as being unprecedented. Meanwhile, these campaigns are in many respects becoming more ambitious. That is, it's more likely that activists seek board representation, and according to an article in the Wall Street Journal last year, this is working. We are seeing more and more activist campaigns that end with the activist getting a seat on the board. Now, the second major change is the rise of passive investors. And so in this figure, we're plotting the percentage of equity mutual fund assets that are passively managed. And we see that this has gone from under 10% in 1998 all the way up to over 30% by 2014. And in fact, just last year, Vanguard had net inflows of nearly $250 billion, suggesting that this trend may not be slowing down anytime soon. All right, so what do we ask in this paper? Well, ultimately, we want to know whether these two trends are related. So specifically, we're interested in looking at whether passive ownership affects the goals of activist campaigns. And so these goals can be gaining board representation. They may be a policy change like increasing payouts to shareholders. We also want to look at whether passive ownership affects the tactics of activist investors. And so these tactics run the full range from having a friendly conversation with management all the way to the nuclear option of launching a proxy fight and trying to initiate a change in corporate control. And finally, we want to look at whether passive ownership affects the outcomes of activist campaigns. That is, does it make it more likely that activists achieve their stated goal? Now, we can certainly think of reasons why passive investors potentially facilitate activism. And so activists face a classic free rider problem in which they bear all the costs associated with an intervention, yet the benefits accrue across all shareholders. So it could be that while the large block holdings of these passive investors will reduce coordination costs for activists and ultimately make it cheaper to launch an activism campaign. In addition, it could be that support for campaigns may increase the expected benefits of activism. For instance, if an activist is able to gain the support of just one or two of these large passive investors, this potentially lends credibility to a campaign and ultimately increases the chances that it will succeed. And so we see anecdotal evidence that both of these channels potentially operate here. For instance, the hedge fund Value Act was able to gain a board seat at Microsoft when they owned less than 1% of all its shares. Now, they didn't go to Microsoft and initiate a proxy fight here. They simply approached management with demands. Now, the reason Microsoft was willing to give Value Act a board seat was because they realized that those demands were backed by a number of the large mutual funds that owned Microsoft stock. In fact, there's anecdotal evidence that activists oftentimes approach mutual funds prior to initiating their campaigns in order to gauge the level of support they'll be receiving. Now, interestingly, this communication can go both ways. And so Bill Ackman talks about how he's oftentimes approached by mutual funds, making what he calls an RFA, or a request for activism. One commentator says that this is the biggest shift in the battle for corporate control since private equity was invented in the 1980s. Activists realize they can influence the concentrated shareholder base at many companies, and they're tapping into the desires of shareholders to see change take place. Now, we can also think about reasons why passive ownership may not have much of an effect on activism. So, for instance, some people have the opinion that, well, these index funds just typically take little interest in how firms are run. And in fact, this cover article from The Economist last year referred to index funds as being lazy investors. Furthermore, there's potential conflicts of interest. And so in Bill Ackman's letter to investors earlier this year, he pointed out that one of the biggest pools of money going into index funds comes from corporate pension funds. And so it may not help these index funds raise money from corporate America if they have a reputation for taking on management and supporting activists. And finally, as long-term investors, in some sense, passive investors are the longest of long-term investors. They may not be interested in supporting short-sighted activists. And so Larry Fink in particular has waged a war on short-termism, and he argues that many of the things being done by activists don't really benefit firms in the long run. Now, ultimately answering this question poses a bit of an empirical challenge. And so specifically, it could be that passive ownership is correlated with factors that directly affect activist tactics and success rates. So for instance, membership in the S&P 500 drives a lot of passive ownership, yet this index excludes less liquid stocks. In addition, it could be things like past performance that affect index inclusion and also have an effect on the outcomes we're interested in studying here. So our identification strategy for this paper involves using variation in passive ownership that stems from the cutoff between the Russell 1000 index and the Russell 2000 index. And so specifically, the way these indexes are constructed is that each June, Russell ranks the top 3,000 stocks according to their end of May market capitalization. It then chops off the first 1,000 stocks and calls that the Russell 1000, and takes the next 2,000 stocks and calls that the Russell 2000. Now, I will point out that there is one exception to this rule. Russell implemented what's called a banding policy in order to reduce the number of stocks that are jumping back and forth between the indexes. And so I won't get into the details here, they're in the paper, but I will say that this is something that we explicitly control for in our regression specification. Now, the important idea here, however, is that these indexes are value weighted, and so the portfolio weights are going to vary considerably around the threshold between the two indexes. And so we see that in the following figure. And so in the first panel here, we're plotting the portfolio weights for the bottom 500 firms in the Russell 1000 index. And in the second panel, we see the portfolio weights for the top 500 in the Russell 2000 index. And there's a large jump in these portfolio weights for stocks at the top of the Russell 2000. They're about an order of magnitude larger here. Now, it turns out there's a similar amount of assets tracking both of these indexes. And so we end up getting a large jump in passive ownership for stocks at the top of the Russell 2000 relative to those at the bottom of the Russell 1000. And it's about a 60% jump. And we'll take a closer look at this in a regression specification in just a few slides. So ultimately what we're going to do is we're going to use this as an instrumental variable. Specifically, we restrict our sample to stocks near the threshold between the two indexes, and then we robustly control for factors that determine which index a stock gets put into. We then use an indicator for assignment to the Russell 2000 as an instrument for passive institutional ownership. So what's our key identification assumption here? Well, this is just the exclusion restriction, which says that after we condition on the index determinants, inclusion in the Russell 2000 does not directly affect the activism outcomes we're interested in studying. So just a few words on the data we're using here. And so our activism data comes from SharkWatch, which creates a database using both company and activist filings, as well as press releases and news publications. And the sample consists of activism events for stocks within 500 ranks of the cutoffs between the two indexes. And our sample runs from 2008 through 2014. And so this gives us a total of 426 activism events against 282 unique firms. We get mutual fund ownership data using S12 filings, and then we'll use the fund names and CRISP identifiers in order to classify funds into one of three categories. And so first we have the passive funds, and these are funds where the fund name either includes a keyword like index or Russell, and then we also use a CRISP mutual fund database classification for index funds. Active funds are all other funds that we can match to fund names in the CRSP Mutual Fund database. And then unclassified funds are those that can't be matched. And so we can take all of these fund types and regress them on an indicator for inclusion in the Russell 2000 and all of our control variables. And so if we look at all mutual fund ownership, we see that there's a positive effect, but it's not statistically significant. However, if we break down this mutual fund ownership into the three types, passive, active, and unclassified, we see that there's a strong and statistically significant effect for passive ownership when a fund is included in the top of the Russell 2000. Now, importantly, we don't pick up an effect for other types of mutual funds, suggesting that more active investors aren't responding to whether or not a stock is classified into the Russell 1000 or the Russell 2000. All right, so we'll jump into the results. We're first interested in studying whether or not passive ownership influences the type of campaigns pursued by activists. And so SharkWatch classifies campaigns into three types. The first type are campaigns that seek board representation. The second type are those that seek a policy change thought to enhance value. And so these can be things like increasing payouts to shareholders or changing the capital structure of the firm. And then finally, we have this other category, which includes things like shareholder proposals, exempt solicitations, and 13D filings with no specific activist intent stated. And we can roughly think about these as being in descending order of how ambitious they are. All right, so we start out by regressing these three types of campaigns onto our passive ownership measure. And then remember, we instrument for passive ownership using an indicator for assignment to the Russell 2000. And we see that there's an increase in campaigns seeking board representation. Now, just to help you interpret these coefficients, we're scaling everything by standard deviations here. And so this is a standard deviation change for a one standard deviation change in passive ownership. And we see that there's a positive effect across the board, significant at least the 5% level. Now, to help you think about the economic magnitudes here, this is pretty big. It corresponds to a doubling in the share of campaigns seeking board representation when we have this one standard deviation change in passive ownership. Now, this is offset to an extent by a decrease in other types of campaigns. Specifically, we see a negative coefficient, though not significant, for campaigns that are seeking some sort of policy change. And then we have a negative coefficient on these other campaigns. All right, so a natural question is, well, why do we see more of these campaigns seeking board representation for the dissident shareholder? Well, an answer for this is the fact that passive ownership potentially facilitates proxy battles by reducing the costs that'll be faced by the activist. And so proxy fights are a common tactic for activist campaigns seeking board representation. And an important feature about proxy fights is that they can be really expensive. And so Ganchev estimates the total average cost at greater than $10 million. And this includes direct costs, things like hiring attorneys or PR firms or proxy solicitation services, and then also indirect costs, things like effort. Yet these costs may be reduced by the large blocks of passive investors. At a minimum, it makes it easier to gauge the support you're going to be receiving from the shareholder base prior to initiating a proxy fight. And so we see evidence of this. And so here we're looking at campaigns that feature a proxy fight. And again, we see that as we have more passive ownership, there's an increase in proxy fights. Again, the economic magnitude here is quite large. We see that a one standard deviation increase in passive ownership is associated with a 135% increase in proxy fights. Now, interestingly, these proxy fights aren't necessarily just an activist trying to get a single seat on the board. We do see an increase in activists nominating a short slate, which is a minority of the board. Yet we also see some evidence of an increase of activists nominating a full slate of directors in order to replace the entire board. If we look at the outcomes of these proxy fights, we end up seeing that there's more proxy settlements. And so specifically, we see that a 1 standard deviation increase in passive ownership is associated with a 0.7 to 0.9 increase in the likelihood of a settlement. Now, we don't see, however, any change in whether the activist wins a proxy fight or whether the firm wins a proxy fight. And so this is consistent with the idea that if a proxy fight is close, if management thinks that the dissident has a chance of winning, well, they're going to do their best to try to settle. They don't want to lose. Now, I'll briefly go over some other results we look at in terms of other outcomes of activism. And it turns out we don't find any impact on the likelihood of things like dividend increases, capital structure changes, or spin-offs. And this is potentially consistent with what we were talking about with Larry Fink before, where many passive investors aren't really interested in supporting campaigns that they think might have short-term goals. However, we do document an impact on corporate control outcomes. Specifically, we see that it's more likely that a target is acquired. In addition, we see that it's more likely that takeover defenses are removed. And so these can be things like poison pills or staggered boards. We also look at other tactics that activists can potentially use. And we don't see any significant impact on less costly tactics. And so these are things like non-binding shareholder proposals or letters to shareholders. And so it doesn't appear that passive ownership affects these tactics that can be used by activists. However, we do see an effect on other types of expensive tactics. And so before we said that, well, there's an increase in proxy fights, which are quite expensive. And in addition, we see that there's an increase in hostile offers, which of course can also be expensive as well. On one other note, we also don't document any change in the choice of activist targets. So specifically, passive ownership isn't associated with a change in the likelihood of a firm being targeted by an activist, nor is it associated with differences in ex-ante characteristics of targeted firms. And so we don't see any difference in previous years' profitability or investment rates for firms that are targeted by activism based on this measure of passive ownership. And so I'll wrap up. So in the last several years, we've obviously seen a dramatic increase in passive ownership. And so the shifting nature of the US stock market likely affects investors' ability to discipline managers. And so this paper indicates that increased passive ownership appears to facilitate activism by other types of investors. The findings ultimately highlight the potential importance of costs associated with undertaking proxy fights and other types of intervention. And ultimately, they shed light on the determinants of activist goals, tactics, and eventual outcomes.